Welcome to this audio flip chart on the manager's horizon and the decision to cater versus create fundamental value. My name is Manfred Frühwirth. I am Professor of Finance at WU Wien, which is Vienna University of Economics and Business. The purpose of this audio flip chart is to show you how the decision of a manager to create fundamental value, or instead to cater to the preferences of his irrational shareholders, is influenced by his horizon. We know that in behavioral corporate finance, there are altogether three goals that rational managers may pursue when they are facing irrational investors: creation of fundamental value, market timing, and catering. It goes without saying that these goals are not always consistent with each other. Especially, there may be a conflict between catering and the creation of fundamental value. This is the case if the irrational investors, for psychological reasons, prefer a strategy that is actually reducing the fundamental shareholder value. On this flip chart, you can see two strategies. Strategy A is one that actually reduces the fundamental value. So in a world with rational investors, the shareholders would never favor this strategy. However, we are in a world with irrational investors. And such irrational investors may still like this strategy. In that case, if the managers implemented this strategy, this would push up the stock price. This increase in the stock price would happen even though the shareholder value actually declines. So the overvaluation created by this strategy even exceeds the loss of fundamental value from this strategy. It goes without saying that on the long run, the stock price has to converge to the fundamental value. Therefore, with strategy A, the stock price on the long run will decline. Strategy B is one that actually increases the fundamental value. So in a world with rational investors, the shareholders would clearly favor this strategy. However, we are in a world with irrational investors, and such irrational investors may still dislike this strategy. In that case, if the managers implemented this strategy, this would drag down the stock price. This drop in the stock price would happen even though the shareholder value actually increases. So the undervaluation created by the distaste for this strategy on the shareholders' side even exceeds the gain in the fundamental value created by this strategy. Again, on the long run, the stock price has to converge to the fundamental value. Therefore, with strategy B, the stock price on the long run will increase. Now the question is, which of these two strategies will the manager implement? Let us first imagine that we have a manager with a short time horizon. This could be, for instance, a manager who is going to retire next year, or a manager who is evaluated by his shareholders every quarter and who needs to be re-elected at very short time intervals. Let us call him the red manager. Now this manager has the following option. he can either select strategy A, where the fundamental value decreases and the stock price increases on the short run, but decreases on the long run. Or he can implement strategy B, that increases the fundamental value and on the short run decreases the stock price, but on the long run increases the stock price. I think it is very clear that this manager, due to his short time horizon, will focus on the short-term price impact of his actions. Therefore, he will choose strategy A. On the flip chart, this selection is shown by the red horizontal arrow. The manager will argue, what prevents me from creating an overvaluation right now that vanishes only after I will have retired? And he will argue, what is my benefit if I create fundamental value right now that only translates into a higher stock price when I'm out of job and my successor already has taken over? The answers to these questions clearly make him implement the catering strategy A. By contrast, let us imagine that we have a manager with a long time horizon. In an extreme case, this could be, for instance, a manager who has received a very long-term CEO contract, who is therefore evaluated by his shareholders on a very long-term basis, and who is isolated from short-term preferences and pressure of his shareholders. Let us call him the green manager. This manager has the same two options as the red manager. He can either select strategy A, where the fundamental value decreases and the stock price increases on the short run, but decreases on the long run. Or he can implement strategy B, that increases the fundamental value, on the short run decreases the stock price, but on the long run increases the stock price. In contrast to the red manager, this manager, due to his long time horizon, can afford to ignore the short-term price impact of his activities. He is able to focus on the long-term price impact of his actions. And this long-term price impact is consistent with the impact on the fundamental value. Therefore, he will choose strategy B. On the flip chart, this is illustrated by the green horizontal arrow. The manager will argue, as I am only evaluated by my shareholders on a long-term basis, what prevents me from creating an undervaluation right now that will vanish over the long run? And he will argue, what is my benefit if I create an overvaluation right now that gets lost even before I am evaluated by my shareholders? This clearly makes him implement strategy B, that creates fundamental value. A very interesting real-life example of strategy B is the case SAP. In 2012, SAP added to its portfolio of business units the cloud services unit. At that time, the shareholders did not appreciate that move, and the stock market reacted with stock price losses. Meanwhile, we know that this strategic step created significant fundamental value to the company and to the shareholders. Fortunately for the shareholders, the managers could afford to take a long-term horizon and ignore the negative signal from the stock market. They did not reverse their cloud services strategy and sustained the short-term loss on the stock market. Meanwhile, the capital market understood the huge increase in fundamental value, and the SAP stock increased massively. Now let us link this finding to a study that has been published by Jim Poterba and Larry Summers in 1995. An interesting table extracted from their study is shown on page 2. In their study, they found out that US managers have shorter time horizons than European or Japanese managers. You can see this, for instance, from the far smaller percentage of R&D expenses that go into long-term projects. This shorter time horizon implies that overall, the tendency to cater instead of creating fundamental value should be stronger for US managers than for their European or Japanese counterparts. It goes without saying that the incentive system has a very strong impact on the manager's investment horizon and therefore on the manager's decision whether to cater or to create fundamental value. If the manager gets a bonus based on a short-term metric like current stock price, current profit, current earnings per share, or current ROE, or if he's employed only on a short-term contract, this increases the danger that he will follow the catering goal, even if that reduces the fundamental value. If, however, the manager gets paid based on a longer-term metric, like the fundamental shareholder value or other forward-looking metrics, and if he is employed on a long-term contract, there is a good chance that he will have a long-term horizon and therefore tries to maximize the fundamental value. And on the long run, this is also beneficial to the stock price. Summing up, the learning outcome of this audio flip chart is: in a behavioral corporate finance world with irrational investors, which is more general and closer to reality than the neoclassical world, there may be a trade-off between creating stock price and creating fundamental value. We saw that different managers will react differently to this trade-off. The longer the time horizon of the manager, the bigger the chance that he will focus on the fundamental value. As a result, we saw that in a world with irrational investors, it may be beneficial, even for the shareholders, to shield a manager from the pressure of the stock market. Note that this is in severe conflict with agency theory. Agency theory says to remedy agency problems between the managers and the shareholders, you should put pressure on the managers. So there is an interesting discrepancy between the recommendations from agency theory and from behavioral corporate finance. The truth is probably somewhere in the middle. This is something that we should keep in mind. I hope you enjoyed this audio flip chart. Thank you very much for watching.